Our next section is B2 Financial Management, and it has got these modules: Capital Structure Part 1 and 2, Working Capital Matrix, Working Capital Management Part 1 and 2, Financial Valuation Method Part 1 and 2, and finally Financial Decision Models Part 1 and Part 2. So let us start with the Capital Structure Part 1. It contains these areas. First, your capital could either come from debt or equity. Means we use mix of debt and equity to finance our operations and growth. We could use debt, different type. We'll discuss different types of debts and different components of equity. Then we will learn how to calculate the weighted average cost of capital. What is weighted average cost of capital, and what are the components that we use to calculate the weighted average cost of capital? So let us go one by one. Let us first discuss debt financing. When we say debt, it means a financial obligation which could be a short term or a long term. When we say short term, it means it could be a short term notes payable, it could be a revolving line of credit, it could be commercial paper. Or when we say long term, it means it could be a debenture, bonds, so on and so forth. So let us discuss these briefly first. Commercial paper, as I just said, that it's a short term source of finance. Why? Because it has a maturity of up to 270 days. And normally, the typical average maturity is 30 days. The important point to note about commercial paper is that it has a denomination, a minimum denomination of $100,000. So not every firm can issue. Only the firms with good credit rating, these firms can issue commercial paper, and of course they can be then sold out in the money market. But remember, since it's a short-term source of finance, so it should be used for financing your account receivables, your inventory, or your short-term obligations. Next we have debentures. Debentures are bonds. Keep that in mind. They are bonds, but they are unsecured, means they are not backed by any collateral. So those who purchase bonds, they are taking risk, because if there is a default, they will be treated just like the general creditor. So how do we protect the interest of debenture holders then? They can't just be kept this way, vulnerable to default. So whenever the bonds are purchased, the firm normally drafts out a bond indenture that contains certain actions the firm will take and will not take. So we can include certain restrictive covenants, which you call those actions that the firm cannot take. Like we may restrict the firm that the firm cannot pledge assets or take additional debts. Such clauses are called negative clauses or negative pledge clause or restrictive covenant. So we can protect the interest of debenture holders this way. Then we have subordinate debentures. As the name suggests, that they are unsecured, just like the above, but they have higher risk than the debentures because they rank lower in priority. So since they carry more risk than the debentures, then that's why, in order to compensate for the higher risk, higher interest is offered. Then income bonds. These are very interesting bonds because interest payment on these bonds is only payable when the firm, the issuing firm, has achieved a certain target income level. If that income level has not been achieved, then there is no interest, which means bondholders are facing more risk, so they must be compensated with the higher return. Junk bonds are very interesting. Junk bonds offer very high return. At the same time, they also have high default risk. So for this reason, they are considered as non-investment grade. But if you want to maximize your return, willing to take on risk, this could be the best opportunity to invest. Then we have another type of bonds, mortgage bond, as the name suggests. These are the bonds that are secured by some real estate property, could be residential property or commercial property. The distinctive feature of mortgage bonds with reference to other bonds is that for mortgage bonds, under the law, the firms are required to appoint a trustee, which invariably is a banker. The property is transferred in the name of the banker. And if there is any default by the firm in making payments of interest, then the trustee would, under the indenture, is required to foreclose the property and liquidate the asset and distribute the money amongst the mortgage bond holders. So that's why, since mortgage bond holders are facing less risk, because of the property backing them. That's why the return on these will be much lower than the income bonds or junk bonds. Then we have an interesting source of finance, long-term finance, leasing. This is comprehensively covered in your FAR. Let us just briefly discuss leasing. Leasing is a contractual arrangement where a party A, the lessor, he allows the lessee to use his property in exchange for specific payments. So this agreement between the lessor and the lessee B is called the leasing arrangement. There are two types of leases, the finance lease and operating lease. Since the leasing standard has been revised both in IFRS and the US GAAP, so whether it's a finance lease or an operating lease, you have to record both of these in our financial statement as an asset and a liability. Right of use of asset and a liability. Remember, in order to designate a lease as a finance lease, there are certain conditions to be met. Let me just briefly tell them. First, if the ownership of the asset is transferred at the end of the lease term to the lessee, it's a finance lease. Second, if there is a bargain purchase option, which is most likely to be exercised and more reasonably to be exercised, in that case, it's a finance lease. Any of these 5 conditions. Third, the present value of minimum lease payments plus any guaranteed residual value, if it is equal to or substantially equal to or greater than the fair value of the asset at the start of the lease, still it's then a finance lease. Then the fourth one, let's say if the asset has a 10 years life and the lease term is 8 years, which means 80% of the life of the asset is covered under the lease. So remember, the criteria is that if more than 75% of the life of the asset is covered in the lease term, then it will be considered as a finance lease. And the fifth one, that asset is a specialized one and it will not have any alternative use. So in that case, it will be considered as a finance lease. If none of these criteria is met, or if the lease is a short term, then it will be considered as an operating lease. I've just briefly described these 5 conditions. If any of these is met, then the lease is considered as a finance lease, otherwise it's an operating lease. So for these detailed requirements, you may have to consult your FAR. Alright, next is equity financing. Equity means issuance of common stock, preferred stock, common stock, preferred stock. Common stock are the owners in the firm. They have the rights to vote. They have the right to elect the members to the board of directors. They are the one who have their say in the decision-making process to some extent through meetings. But the preferred stockholders, they hold an instrument that is considered as a hybrid instrument, because preferred stock is somewhere midway house between bonds and the common stock. It has a feature of bond because the preferred stockholder get paid a fixed amount of dividend. It is a characteristic of equity because the payment of dividend is at the discretion of the directors if they decide to, otherwise no dividend. So that's why preferred stock is considered as a hybrid equity, because it has feature or characteristic of both bonds and common stock. Then there are some types within the preferred stock. Cumulative dividends means if the prior year dividends have not been paid, then first the preferred stockholder dividend will be paid their pending dividend. Only then the dividend to the common stockholders would be paid. The other characteristic is participating feature. There's some, not all, some preferred stock have participating features, mean they will get their regular dividends, the fixed dividend, plus they are also entitled to participate in the profits if the profit exceeds a certain threshold. So a fixed amount of dividend together with participation in profit if and only if the profit exceeds a certain threshold. And they don't have voting rights. Preferred stockholders, they do not carry the voting right. In very rare circumstances, their voting right is enshrined only when their dividends are in arrears, and so they must be listened to, so they must have their voice heard. Then we have common stock. As I discussed, that common stock represents the basic equity ownership. They have the voting rights, and they are the one who are standing last in line. When the company is liquidated, we pay to bondholders, secured bondholders, mortgage bondholders, and then so on, and preferred stockholders. In the end, if anything is left on liquidation, then it is paid to the common stockholder. So they are standing at the last. They have the lowest claim to firm's assets, and that's why they are carrying the highest risk, and that is the reason they are given the highest reward. Common stockholders have the highest return or highest required rate of return than all the different providers of fund. We have basically discussed debt and equity. So let us just make a comparison between them. The following table summarizes some of the general characteristics of debt and equity financing. Debt has no flexibility. Once issued for a certain time period, you will have to pay interest on a regular basis and pay off the full amount, the principal amount at the maturity. Equity is much more flexible. You may not pay dividend for 10 years consecutively if the directors so decide. When we pay interest, it is tax deductible. The payment of preferred or common stock dividend, it is not tax deductible. Issuance of debt will not affect the current concentration of power with the shareholders, but when you issue more shares, the concentration or the power of shareholders is reduced, or in other words, EPS is diluted, because now the earning is distributed to more shareholders. Increased financial risk. When you issue debt, the financial risk goes up because you have to pay a certain amount interest, whereas equity doesn't result in any increase in financial risk. Security issuance cost for debt, it's low. Equity issue is quite an expensive activity. Investor return is fixed coupon in most of the cases, whereas the return on equity is pretty variable, could be sometimes very high, sometimes very low. Next, we have the weighted average cost of capital. We have different components, different sources of finance. We have loans or debt, we have common stock, we have preferred stock in different proportions. So what is the aggregate, the overall average cost of all forms of financing the firm uses? This is called the weighted average cost of capital. And the ideal capital structure is the one that overall lowers the weighted average cost of capital, mixing these in such a way so as to attain the lowest cost of capital, and this would mean that the firm can deploy these funds more profitably elsewhere. So how do we compute weighted average cost of capital? Let's say we have three sources of finance: debt, preferred stock, and common stock. Let's say debt is 20% of our funding, preferred stock is remaining 30%, and 50% is common stock. So these are the weightages or proportions. The component cost of these sources of finance, let's say debt after tax cost of debt is 5%, it's 8%, and it's, let's say, 10%. Now taking and calculating the weighted average, 20% of 5 plus 30% of 8 plus 50% of 10. So it's 8.4%. This 8.4%, the weighted average of these funds, is basically what you call the weighted average cost of capital. So we have this formula which you can use, like these are the component cost of equity, preferred stock, and after the cost of debt. And let's say if V represents the total amount deployed, let's say $100,000 is deployed by the firm, out of which E amount or E dollars represents equity, P dollars represent preferred stock, and D dollars represent the debt, and combining all these means $100,000. So we can calculate WACC this way, but this is pretty tedious. If you have the numbers and the percentage, the component cost of debt, you can do it the way I have done it, quite simply. Moving on, a question here. Assume that the cost of common stock equity for XYZ company is 8.4%. The cost of preferred stock is 6.8%. The weighted average interest rate on the company's debt is 6%. Also assume that the market value of percentages of each component of the capital is 55 for common stock, 20% for preferred stock, and 20% for debt. So let's write this down. Equity is 55%. Then we have preferred stock, that is 20%, and debt is 25%. Let us write down their component cost as well. The cost of equity is given as somewhere here, it was 8.4. Preferred stock has a cost of 6.8 in fact, and then the debt has a cost of 6. Remember, it's a pre-tax cost. It must be brought down into after-tax basis, because remember, the interest is tax deductible. Interest expense is tax deductible. It shields some part of your profits. So when you calculate the cost of debt, we'll discuss later on, it is calculated this way: the coupon or the percentage multiplied by 1 minus tax rate. So if you simplify, it's going to be 4.2%. Now if you take the weighted average of these, 55% of 8.4, 20% of 6.8% and 25% of 4.2. What you get is called the weighted average cost of capital, and it is equal to 7.3%. So the components of our long-term financing might include long-term debt, preferred stock, common stock, retained earning, but we do have some short-term fundings that come from our notes payable, accounts payable, accruals. So since normally we don't use them in our calculation of cost of capital, so we focus primarily on long-term elements only: long-term debt, preferred stock, and common stock, and of course retained earnings. Let us now discuss how do we calculate the cost of debt. For this we use this formula: effective interest payments. Let's say if we make interest payment regularly of $10, the debt outstanding, let's say the current market price of the bond for which we paid $10 interest, it's $950. So just using the interest payment and dividing it with the market price of the debt will give you the cost of debt. Then we multiply it with, since interest is a tax deductible expense, you multiply it with 1 minus tax so as to give it the after tax cost of effective interest. And then finally, this is what I'm talking about: pre-tax cost of debt found here, you multiply it with 1 minus tax so as to bring it into after tax basis. And the reason has already been discussed, because interest is a tax allowable expense, so it has to be taken on after tax basis. And no such calculations are required for retained earnings, preferred stock, or equity. Assume the long-term debt components of the weighted average cost of capital for a firm includes pre-tax cost of 12.5, tax rate 30. You need the cost of debt after tax, of course. So pre-tax is 12.5%, multiplied with 1 minus tax rate, it will give you 8.75. This is the after tax cost of debt, and that what we should use in the calculation of our weighted average cost of capital. Moving on, next we have the cost of preferred stock. Preferred stock, as we have discussed, that these are the stockholders that are preferred on the common stockholders with regard to dividend payments and the distribution of liquidation proceeds. They are one step ahead. Preferred stockholders, they get paid fixed amount of dividend. And how do we calculate the cost of preferred stock? Normally the formula we use is cost of preferred stock is the dividend we pay divided by the market price of per preferred stock. But sometimes we may have to calculate the cost of freshly issued preferred stock. For this we have the formula: preferred stock dividend. Let's say the fixed dividend payable is $6, and we have issued the preferred stock at $105, whereas there was a flotation cost of $7. So $105 was issuance, $7 was the flotation cost. You received $98, and this $98 is called the net issue proceeds. So remember, for freshly issued preferred stock, newly issued or to be issued, we use the dividends divided by net issue proceeds. For existing preferred stock, this is the formula. For the new preferred stock, you use the net issue proceeds in the denominator. You will use the same thing here. If new bonds have been issued, you will take the interest cost divided by net issue proceeds multiplied by 1 minus tax. That was the point to be noted. Then we have an example to solidify your understanding. We need to calculate the cost of preferred stock. Assume that the preferred stock component of the weighted average cost of capital form a 10%. The weightage 100 par value preferred stock was issued at a par value with flotation cost of 5. So that's the issue price, that's the flotation cost. So the net issue proceed is basically $95. So if you have to calculate the cost of preferred stock, it's equal to dividend, which is going to be straightforward 10% of 100, that is $10, divided by net issue proceeds. So 10 by 95 times 100 gives you 10.53. This is going to be the cost of your preferred stock. Next we have the cost of retained earnings, or more precisely the cost of common equity. There are three methods that we can deploy to calculate the cost of retained earning. First is the capital asset pricing model. Then we have the discounted cash flow model, also called DDM. And then you have bond yield plus risk premium. Let us just briefly discuss all of these. First we have the CAPM formula. The cost of common equity is risk-free rate RF plus risk premium, which is beta into RM minus RF. This is the full version of the formula of CAPM. Risk-free rate, that is the rate on treasury bills. Beta is the measure of volatility of return on the asset with the return on the market, and RM is the return on the market portfolio, and RF same is the risk-free rate. So you just need to plug in the numbers. Let's explain the idea through an example. Assume that the firm's beta is 1.25. Now listen, if beta is equal to 1, which means the firm's stock moves exactly in line with the market stock, overall market portfolio. If beta is greater than 1, like in this case, it means it's more volatile. If the market goes up, your stock goes up higher. If the beta is less than 1, let's say 0.25, in that case, if the market returns go up, your returns go up, but to a lesser extent. So remember, beta equal to 1 means the returns are perfectly correlated with the market returns. Greater than 1 means more volatile, less than 1 means less volatile. If beta is negative, it means your returns are negatively correlated with the returns on the market. So it's a measure of systematic risk, measures how volatile your returns are with the return on the market. So beta 1.25, that is beta, risk-free rate RF, and the market RM return is 14.25. We just have to calculate the desired rate of return, ER or RE or KE, whatever you call it, they are all the same. RF plus beta times RM minus RF. The risk-free rate is given as 8.75, which is pretty high, I believe. Beta is 1.25 times return on the market is 14.25 less 8.75. So if you just simplify, this would give you the cost of common equity using the CAPM model, and it will be 15.63%. The next one is the dividend discount model or the discounted cash flow model. This model assumes that if the future dividends are discounted at the firm's cost of capital, the discounted value will be equal to the current stock price. So there are two versions to this formula. Cost of retained earning is equal to D1 upon P0 plus G. D1 represents the dividend that is going to be paid at the end of 1 year, the next dividend. P0 is the current share price. G is the constant growth rate in dividends. Now, there are two formulas that we can use. One is given here. Sometimes you are given the current dividend, the dividend that has just been paid. So the formula will be a little modification of this one that is shown here. Then in that case, instead of writing D1, you will write the current dividend D0 into 1 plus G. Effectively, you can say that D1, the next dividend, is equal to current dividend growth at G% rate. So this is the same. D1 is equal to D0 into 1 plus G upon the current share price plus growth rate. So you can use this formula to calculate the cost of retained earning. Now, let's say if the firm issues new shares. This formula will then be little different now. Cost of new equity, I'm going to write it as NE. The cost of new equity is equal to now D1 upon the net issue proceeds. That is, if you sell the share at 115, but there is a flotation cost of $7, it means the net issue proceeds per share is going to be 108. So it's going to be the net issue proceeds plus growth rate. So remember, for the cost of new shares that are issued, in the denominator you have net issue proceed, rest is the same. Instead of P0, you will have net issue proceed. This one then will be D0 into 1 plus G upon net issue proceeds plus growth rate. Let us apply this concept in a question. Assume that the firm is a constant growth firm that just paid an annual dividend of $2. This is not D1, this is D0, just paid. Has a dividend growth rate of 7.5, that is G, and a current market price of 25.25. Now, no, we won't use this one. It's D0 given into 1 plus G upon current share price plus growth rate. So it's D0, that is 2 into 1 plus 7.5. So I'm going to write it as 1.075 divided by the current share price 25.25. And to this simply add the growth rate that is given as 7.5%. Convert this factor into percentage. It's going to be 8.51%. And to this add the 7.5%. This will give you the cost of retained earnings, the cost of common equity, which is going to be 16.01%. That is your result. Moving on. The third approach, called the bond yield plus risk premium. Since common stock is riskier than debt, so we have to add a certain market risk premium so as to compensate for the high risk of the common stock. So remember, we need to take pre-tax cost of long-term debt as the starting point. Why pre-tax? Because there is no after-tax impact on common stock or the preferred stock cost that was discussed earlier. And remember, the market risk premium is RM minus RF that we have discussed in the CAPM component. This is called market risk premium. So pre-tax costs of long-term debt plus the market risk premium, which is simply RM minus RF. Let us apply this concept in a question. Assume that the firm has estimated its market risk premium to be 4.5, which is RM minus RF, and has determined that the yield to maturity on its bond is 11.34. You just simply have to add these both up, which means your cost is going to be 15.84%. So this would be the cost under the bond yield plus risk premium method. Now the question is, which of these method is preferred? So each method is valid. What we can do, if we may calculate results from these three methods, and we can just simply take the average. Like in this case, we calculated these three and we can simply add these three up and divide by 3 will give us the average, and if we do, it will give us 15.83. So this is your average of these three methods, and you can use this instead rather than using a single method. And that ends your M1 capital structure part 1. It's just a brief overview which covering just 20-25% of what you should learn. The remaining 80% is coming from questions, MCQs and simulations, which are a part of this complete M1 study. So don't just focus on the overview only. Questions are an essential and integral part of your preparation, questions and the simulations. So they must be done together when you're doing this M1 or any specific module.